All right, welcome back, everyone, to Trader Chats. And it's another one of those Macro Avengers sessions you've all been waiting for. We're going to do a Q4 Roundtable. We've got the Hulk there in the middle, as you can see. Darius Dale, a.k.a. Darius Dale from TGMacro. I'm sure he needs no introduction. Then we've got Tony Greer from TGMacro. Welcome, guys. How's it going?
Hey, Imran, what's up, buddy? Tony, what's up?
How are you guys, man? It's good to get the gang back together for another convo, man. The world's changing at light speed, huh?
It is, man. It is. I was just joking with you, man. Every time I see your pretty face on one of these, I'm about to get squeezed in the market. So
the market goes up when we go on tape.
Exactly.
All right.
Yeah. All right. So I'm just going to So last time we got together, I think it was late July, and we were all pretty adamant about the market having not seen the bottom yet. Although we were in the middle of a bit of a short squeeze, which Tony was very fully playing. The rest of us were kind of waiting patiently to resell it, I think. And then that rally kind of continued into middle of August, and then the markets obviously rolled over as we continued to see more sticky inflation and yields started ratcheting higher again. So now recently we've seen a similar sort of setup where markets made new lows. They bounced pretty strongly off the bottom. They got a whiff of the idea that the Fed is going to slow down after the November meeting that's coming up after San Francisco Fed President Daly's comments. We also got the Nikkei leaks, as it's now being popularized. The guy in the Wall Street Journal who kind of pretty much tells you what the Fed's going to do. So the market's cottoned onto that and seems to be trying to rally right now and squeeze. What do you guys think? I mean, Darius, why don't you start us off and just kind of, in the context of that, I think we've lost Darius, have we? That's a good start. I guess we're going to have to go over to you, Tony. Oh,
there
Darius, you're back.
Okay. Oh, did I freeze? Oh, sorry. My apologies.
Yeah, disappeared. But,
yeah, no worries.
Do you want to give us your kind of your general sort of outlook at the minute and kind of in the context of what I'm saying about this squeeze that's ongoing?
Yeah, absolutely. So I always think it's a good practice, just because we have different different types of investors watching to kind of think about the world and different durations. Sort of from a risk management perspective, we tend to focus on things that occur, under one calendar year. That tends to be where most of the volume and actions and trading tends to take place. And if you think about it on a sort of 6 to 12 month forward basis, we're pretty sure that we know that we're going to wind up in a state where the Fed is very clearly pausing, assessing the damage that it's done to the economy through the long and variable lags that monetary policy tends to work through the economy in terms of trying to achieve its inflation objectives. That sort of the path to getting to that state is likely to occur over the next few months. Which is the Fed will sort of signal officially to market participants that sort of it's concluded its rate hiking process, and it's about to do that. So it's our view that process there is likely to contribute to some upside tail risk, right tail risk in the market, just given where positioning is and given where sentiment is. The problem with that, from our perspective, and again, this is our view, and we can debate this later in the presentation, is that I don't know that the path to getting to that pause is as clear as the markets are probably interpreting it this week. And again, we're recording here on Tuesday, October 25th. It's our view, there's a couple of inflation reports between November 2nd and December 14th Fed meeting. And it's not clear to us from the perspective of how strong and resilient the U.S. economy has been that we're going to see any materially positive dynamics on the inflation front, particularly with respect to core inflation. So we think there's certainly risk relative to a lot of the incremental positioning in the market between now and let's call it, December 14th. And then probably beyond December 14th, there's probably some upside risk associated with, again, the market eventually moving to that pause. We'll talk a little bit later. Beyond that, you still have to kind of live in a world with a 5% terminal Fed funds rate and what that ultimately means for the economy. We do believe we're headed for a hard landing at the end of this rainbow, and unfortunately, that hard landing has not been adequately priced in. So 2023 is likely to be quite as volatile as 2022, just probably not kind of one direction to the downside.
Interesting. Tony, you want to jump in?
I can't take my eyes off the S&P rally right now, Imran. I'm sorry. No, I'm just kidding.
That's good. You're wrong, mate.
Yeah, well, it's good to get confirmation that you're right every once in a while, right, Imran? I mean, we did a lot of sweating down at 3,600. when I talk about the, where the tape is, I talk about it within the context of sort of the price action and this move and the way that it's taking place. We got the market back down to the lows when the macro world was literally exploding, right? When dollar yen was sprinting through the 140s, gilt market was coming apart. And that was what was putting so much stress on the S&P and the VIX. And then along comes the Bank of England, and whether it is successful or not in the end, we don't know yet. But so far, the line that they've drawn in the sand in the gilt market has held. And then we got to a point where dollar yen went to 150, which is sort of, to me, very conspicuously a 50% devaluation from the range that had been in the last, call it the Trump administration, right? Before the heavy inflation set in. So now you see dollar yen getting to that point where the Bank of Japan steps in, and automatically what you have is sort of the cooler heads prevailing at the macro table and slowing down the volatility in the macro world. Now, what is that leading us to in the stock market? That slowdown of volatility in the equity world is allowing equity investors to take a breath, realize how cheap things are, and then sort of drill down into the price action if you're a short-term trader like me. When we broke 3,600 the other day, last Thursday, and had that 2% spill followed by a 2% recovery, as we always used to say on the floor of the exchanges, that's a good low, right? You can lean on that low now and trade the other way. And, it takes a lot to get out of that hole, as you can see, but eventually you get a positive feedback loop. You get leadership out of commodities. You get the dollar to back off and all of a sudden touch its 50-day moving average for the first time in a long time. You got rates not all of a sudden making new highs. And all of a sudden, the short position in that massive sentiment bubble of negativity that we've been blowing, some of them, the last ones in certainly have got to run for cover. And I think that's probably what you're seeing here. I just think that this particular move is going to have a lot of legs to it because we are in a serious negative sentiment bubble. We've seen things like the put call ratio go completely berserk. I just think there's a lot of unwinding of the shortness and bearishness that needs to come out. So that's where we're set up. You guys are spot on. And I kind of follow you guys when it comes to the Federal Reserve for guidance. And I agree that they're going to be in a bit of a pickle here with the economic data getting worse and the inflation getting worse at the same time. So they're going to have to pick what they address. And like I said, I defer to you guys. But that's my take right now.
Yeah, so I get the sense for what you're saying is there's a lot of technical reasons why we needed to rally. We got some strong price action off bad inflation data, which is obviously a good signal that things are just a bit too bared up. We're now starting to see that compression back of volatility that was very elevated. And generally when that happens, you do get a bit of a relief rally. So the question really for me is this going to be another short squeeze that's going to be short-lived and probably make a lower high? So last time we got to 43.25, which was that 200-day. Where do we anticipate this set rally could get to? Are we talking about 4,000, 41.50, something like that? And then we're taking off all our longs and looking down again, because the odds are that the Fed doesn't get to give us the pivot that we're all looking for because the data doesn't allow it, basically. So I get the sense that's what Darius sees coming. But Tony, where do you see a target for the upside potentially?
Yeah, I'm, right in the ballpark of ranges that you just threw out. I could see the S&P going to the 200-day moving average resistance up at 41.35 or so. I mean, at that point is where I would like to be letting out a good bit of my tactical trading long. And from there, I kind of take a fresh breath because things can get a little bit hairy if the options position is as short as it looks like, right? That's where you have all kinds of crazy, delta coverage stories. You have all kinds of crazy strikes coming into play, and that's where the upside could get a little bit hairy. So I'm prepared for that. I've got some set of probability assigned for that. But I think we're going to be in an orderly trade higher here to the 200-day, and I would be looking to pivot my book to book the short side there because this seems like a pretty damaged S&P, and we're heading into the last few months of the year where you generally see things heading in the same direction, only more furiously into the end of the year. And that's just an observation that I've made over the years.
Okay. Yeah, so and we're seeing, TLTs has been in free fall recently, and it's having a 3% bounce today. There's been some chat about some sort of Operation Twist-like action coming out of the Treasury, not the Fed, and I think that's kind of helping this bond market bounce. I guess over to Darius, like, where do you see these yields getting to on the upside? Right, I mean, if a pause or a pivot maybe isn't on the cards yet, based on the macro and based on the fact that inflation is going to be as stickier than the market kind of wants it to be, then how high do you see these US yields actually going? And do you think the re-steepening that we started to see continues?
Yeah, so I mean, look, the yields are going to go until they're as high enough to make you, me, and Tony buy bonds, right? Like that's the goal of this exercise is to get the Fed. The Fed is trying to get you from making speculative investments and over consuming and putting pressure on supply chains, both goods and services, and to put that money into safer U.S. government securities. Clearly, they have not found the appropriate level from the perspective of the volatility that we're continuing to observe in the bond market. We've had a view on for nearly 2 months now that we're probably going to see somewhere north of 4.5% on the 10-year, probably north of 2% on the 10-year tips yield. We're probably we're a little bit closer to that on the nominal, but on the tips, we probably a little bit 35, 40 basis points away. So we're not sure that the market is fully priced in. Sort of the kind of the stickiness, if you will, of inflation. We've been talking about at 42 Macro how the disinflation process from the cycle peak is proving itself to be sticky and stochastic, and that sort of non-autocorrelated, non-aggressive nature of this process is likely to kind of force bond kind of a buyer strike in the bond market, which we're obviously observing on our screens, albeit absent the move we're seeing today.
Yeah, and normally you would have expected like tech stocks to be under pressure given how under pressure bonds were, but they started to dislocate. So did you put that down to these sort of technical factors within the equity market, and people are just saying, well, if we're going to get a squeeze, I want to own this high beta tech stuff, and maybe it's a bit of pre-positioning for earnings. We've got the big techs reporting this week. What do you think? Why is NASDAQ diverging from bonds the way it has been?
Yeah, absolutely. So I think flows is probably the number 1 and 2 answer. There's a couple things we look at 42 Macro to track flows. From a short-term perspective, we have our crowding model where we're looking at the relationship between various measures of volatility, risk premia, ones that backtest the best, and the relationship and deviations in realized volatility. And heading into this week, it's pretty clear that markets were in a state that sort of suggested we should see some pretty decent returns to start this week. That signal was followed by a pretty negative signal on the long side of the VIX, which obviously would add fuel to the fire from a Vanna flow perspective. So I think we're getting the confluence of these very immediate term technical factors, kind of overwhelm, what I believe is becoming an increasing disconnect between deteriorating macro fundamentals and these positive flow dynamics. I mean, we saw in August, some of these flow dynamics really get us to the upside. Kickstart what was very ferocious and sustained 2-month bear market rally to the upside. The one thing I would say is flows only get you so far from my perspective. What we saw throughout the month of July and throughout the month of August, we saw nearly $300 billion expansion in U.S. dollar net liquidity, which we can touch on in a second. And we also saw money market rate price in 3 rate cuts at the lows in terms of the delta we observed in 1 year, 1 month forward overnight index swaps. And so, that's something that we talked about at the time is, hey, we're in this phase 2 of the global liquidity cycle downturn, whereby phase 2 is where the market starts to price in the dovish Fed pivot that's going to come from the other side of all the slowing the Fed is causing. Well, we're not in phase 2 anymore. Jay Powell's more or less slammed the door shut on that twice, really, starting at Jackson Hole and obviously at the September FOMC. And it's our belief that they're going to continue to slam the door shut on these sort of phase 2 type expectations in the marketplace, which in our view limits the upside and the scope for any sort of bear market rally this particular interval.
And the rates market has kind of priced that we're not going to get this sudden U-turn necessarily next year, and they kind of pushed it more into 2024, it seems, right, in terms of those cuts. What about you, Tony? What do you think on yields? Do you think yields have got room still to go a lot higher, like Darius thinks, or are you in a different camp there?
I do overall. In the short term, I feel Imran, if there's a chance you could turn down your volume, I think that might be what's giving us a little bit. I'm getting a big reverb off of what me and Darius are saying. I think it might be because your mic is up and you don't have headphones.
Yeah, let's try that.
It might not be, but I'll keep going. My only point on yields. It's hard for me to make to do anything other than observe trend and kind of understand what it's doing to my trades in the equity market right now. But the only thing that I do see is I see potential reversal in the 2-year yield that coincides with the Bank of Japan intervention. I've got technical indicators like the Tom Thornton type of DMARC stuff that shows that yields are getting, ahead of themselves and potentially overbought in the short term. It's just something that would require potentially a pullback to moving average support, and to stay within trend for a little bit more of a healthy rally so that it's not a sort of, runaway Icarus print type of trade, because that's when the market gets scared for a real bond market dislocation. When yields were in the 2-year were kind of ramping and ramping and ramping, that was the risk was, are we going to come in? Yeah, we're going to come in Monday morning to a 50 basis point bond dislocation, and everybody's going, oh shit, and a potential Black Monday equity slide.
In the UK.
Yeah, exactly. Like that.
So
that
in the UK, right?
Yeah, 100%. So it's just kind of wrestling that, and it looks like bond volatility has calmed down a little. I'm not saying that it's over, because the bond market volatility is going to be with us. As you mentioned, we've got a big reversal today in yields, with now an island reversal in the TLT market, which was off 48% from its peak at one point, just utterly destroying everything in its path. So I feel like the dollar, broadly speaking, the dollar got to the point where it was breaking things and people had to come in and kind of calm everything down, meaning the Bank of England and Bank of Japan. And I just think from this direction, the trajectory should be lower in yields, just to sort of take a little bit of heat off of the markets that they've been feeling. I don't want to go in the wrong direction with this part of the conversation, though, Imran.
Yeah, but within the context of a trend higher still in yields, it's just like we're thinking it's probably a corrective bounce in stocks still. Similarly, it's probably a corrective pullback in yields, because the trend is likely still higher. Fair to say?
That is fair to say. And I also believe that because the longer we have an attack on energy supply, the longer we have a lack of investment, the longer we start to create this animosity between the U.S. and Saudi Arabia. None of that stuff is bearish for energy prices. And to me, that is going to be sort of the lever that constantly forces the bond market's hand lower. That's why I agree with that. But it's all going to be part of the ebb and flow of trading. But yeah, that's how I think we wind up.
Right,
Tony, real quick, I just have a quick question on the strategic midterm release. Do you have any sort of insights as to when we might stop seeing the U.S. government sort of heavy hand over global energy markets, like when that trade might be over from their perspective?
We've got to be getting to the 6th or 7th inning, Darius, and nobody can really get an accurate handle on exactly how much is left, that he can announce sales of. And then there's another congressional sale of oil that takes place, which is, a couple of 100,000 barrels that I'm sure he's going to try to ram down the market's throat before midterms. But because that sale becomes eligible in October. So now, anytime during the course of the year, he can sell that oil. So there's another component to it. To the midterm, the strategic midterm petroleum reserve. And I don't have a clear answer, so I'm not going to go ahead and guess, but we are getting into the later innings of
strategic midterm.
Yeah, of there. I think, so someone coined that brilliantly. I think it might have been zero hedge the first place I saw it, but I thought that was brilliant. But we're getting into the later innings of it, no matter what. Yeah, and heading towards midterms, the way, as Doomberg has pointed out, this administration has been playing the game with their cards open. Right? They're playing poker with their cards open. And this is such a blatant attempt to lower the gas price into the midterms that I would be willing to say that we aren't going to be talking about what Biden thinks of gas prices in another 3.5, 4 weeks. So in my opinion, that's going to take the political motivation to keep using the SPR away and, potentially take away the one major seller that we've been able to draw a circle around, as oil merchants in the market, and say, the biggest seller in the market right now is the Strategic Petroleum Reserve. And that's probably why the market is held down below $90, $95. Otherwise, it would go shooting higher. So when we get to the end of that, you can expect an absolute, almost undoubted WTI crude oil rally.
Mm-hmm.
Yeah, on that point, I started to notice in the oil volatility market, the skew is very much flipping back towards calls. It's not quite there yet, but it's been for puts for ages now, the skew, because people were thinking China's slowing down, world's slowing down, demand's coming off, and you've got this big seller. But you've definitely in the last month started to see that be much more neutral. So the pricing calls versus puts being more neutral. So I think the vol market is cottoning onto the fact that there is some potential explosive upside coming. I mean, I'd like to see that actually flip to be a premium for calls to really believe in it. But it does look like some option players are coming in and selling puts and buying calls, because
that's really,
especially if Biden's saying he's on bid at 7.
Great to hear. I was just going to say, Imran, that's really important to hear for this trade, because to me, what I interpret that as is the options market is starting to figure out, the OPEC side of the trade. Joe Biden's been saying, here comes more strategic petroleum, here comes strategic petroleum. And OPEC turns around and says, well, that's going to mean a weaker economy. We're going to have to cut output. Right. And the bond market, the options market is saying, oh, there's finally a counter move to this trade. Right. So that balances things. So it's interesting to hear that that's how the narrative in the options market is running as well, sort of more towards balance rather than downside skew.
Yeah, exactly. All right. And we jumped onto commodities a bit earlier than I anticipated, but it's fine. Just the last thing on the Fed. So a lot of people have kind of been keeping an eye on this net liquidity function. And I know you look at this quite closely, Darius, right? To get a sense of what the fair value for the S&P is, because they track really well when you include the TGA account and the reverse repo facility. So what's your thoughts on that in terms of heading into the end of the year? And also, do you think, I feel people on Twitter are paying a bit too much attention to it in terms of day-to-day swings of the market. I think it makes sense to see where the trend in that thing is going to give you some sense, right? But what's your take on it?
Oh, so I'll start by saying I think we've created a monster here, because I completely agree with you. It's not a very near-term tactical trading signal. How we use the net liquidity function in our process is to understand sort of the momentum of the time series in the context of the forward, guidance that we're receiving from the Fed, and we try to spot, sort of big dislocations between net liquidity and the broader markets, through the lens of correlation analysis, et cetera. And so one example of this would be going back to mid-August, where net liquidity sort of petered out to the upside. We had a sustained rally from the lows of June through the upside kind of in early August, and it kind of petered out. But we saw the stock market continue to rally strongly into kind of the peak euphoria around kind of phase 2 Fed pivot dynamics. And then ultimately, we obviously saw the unwind of that pretty ferociously in the 6 weeks from kind of mid-August through late September. So in terms of our outlook for net liquidity, you kind of let's break apart the core components individually, because again, this is the number one thing that has been driving asset markets, not just in this particular market cycle, but since my career started in 2009. So until that until the model breaks, I think we have to, at least the bare minimum, pay homage to it as investors and understand kind of where it's likely headed. We know where it's headed from the perspective of the Fed's quantitative tightening program. So that's a $95 billion a month thereabouts governor on the or sort of decay function on top of the net liquidity function. The reverse repo facility is the kind of the most sort of I think it's probably the hardest thing to forecast in the context of all the different puts and takes on why net or reverse repo facility A exists and B is kind of experiencing large or small uptake. The primary factor of that driving that is we continue to see a shortage of T-bills in the marketplace, as evidenced by the negative spread between money market rates and T-bill yields. And as a function of that, investors looking around realizing that the highest yield on the block and also the safest place to park capital is actually at the Fed. And that's an issue for the markets because, again, when you park money at the Fed, it is not rehypothecated. It's not lent back out further out. There's no daisy chain of collateral lending that sort of benefits asset markets and benefits the economy. It's truly a black hole for excess liquidity in the system. So It's our belief that based on the continued path of interest rates, again, it's one thing for markets to price in money market rates, Eurodollar futures, overnight index swaps, Fed fund futures, et cetera, to price in what they think the market rate is going to be. It's another thing entirely for reserve managers at funds, companies, et cetera, to look around and see a realized yield. So again, we're going to get another 75 basis point rate hike next week. We'll follow that up by, let's say, 50 to 75 on December 14th. And so the attractiveness of that Fed facility is going to get increasingly attractive to the extent Treasury Secretary Yellen continues to sort of restrict Treasury bill supply in the coming months. And by all indications from the previous quarterly refunding announcement guidance that we got, and by all indications from her guidance that we received on Monday, the 24th, about, sort of market functioning, et cetera, it's unlikely that she sort of breaks rank in this sort of coordinated inflation fight that we're seeing in the U.S. government. So it's our belief that reverse repo facility balance will likely to continue to trend higher over the next few months as well into year end. And then you sort of have to think about it from the lens of the Treasury General account. Now that this is the least, in our opinion, forecastable part of that sort of equation, if you will, because again, so much there's so many different puts and takes. The timing of tax receipts, the size of tax receipts, different spending outlays, et cetera, et cetera. It's hard, it's impossible to get your sort of hand around that. But one thing that's really helped us throughout the year in terms of projecting net liquidity and ultimately some of these outcomes in the market, which is understanding that, Treasury Secretary Yellen last fall guided to $500 billion as the floor for the Treasury General account, really on the other side of all the kind of debt ceiling drama that we experienced in that particular interval. So we know at, roughly $600 billion, there's not much juice she can really add to it if they're going to be consistent with that guidance. So it's our belief that net liquidity is headed lower, and as a function of net liquidity heading lower, it's unlikely that we, again, all of that does is reduce the scope for these sort of flow oriented dynamics to take the market higher. You need to see a positive inflection in macro fundamentals, namely through the lens of net liquidity, that to really get the markets kind of on a sustained rally.
Yeah, it's a bit like an elastic band, isn't it? Like if you get stretched too far away from what that model is saying, you feel more confident about playing the mean reversion back towards that level, basically. But we clearly can dislocate 400 points on the S&P away from it, right, in the short term, like we did in August.
Yep.
Okay, going back to energy then, and this is obviously TG's area of expertise. So you're clearly bullish on crude, and we think that once the SPR offer goes away, there may be some pretty violent, rapid repricing in that market because of the supply-demand imbalances that may be there. What about the gas market, right? So you're clearly seeing a very, very fast pullback in TTF, and that's filtering through to US natural gas now as well, right? It's just blasting through support. I know Darius isn't going to want to talk about this.
I'll talk about it. Hey, we get trades wrong. We're not Bernie Madoff.
That's right, man.
We got plenty of trades wrong this year, by the way.
And those are the best ones to talk about.
Yeah, exactly. That's what you learn.
So what do we think on nat gas? Do we think this thing's got more room to the downside? Do we like it longer term? Do you think the structural issues remain? It's just a very short-term oversupply issue because they've filled up their storage in Europe and now they're actually going to end up with too much of the stuff? Like, what do we reckon?
You nailed it, Imran. Everybody was playing for the European shortage. Clearly, the rally that we saw in Dutch TTF to like €200 per megawatt hour, and in the US to $10, per billion cubic feet, BCF. That was the Europeans buying and filling storage like drunken sailors, right? That rally that we saw on the screen was actually them filling up their tanks. And the precipitous fall from $10 to $5 was the absence of that buyer. So as we've, seen, they are pretty much set for this winter's storage. The trade is over. The crisis is not, right? And so now the natural gas trade here is unwinding. It was a crystal clear breakdown below the 200-day. I mean, a literally textbook technical breakdown in natural gas, to the point that, I think when it went through $7, in our Slack channel conversation, we had the conversation literally bid 4 to cover. This thing is done, right? So we had all the elephants out through the keyhole. So far, it's bottomed at $5, and that may be the low for now. But the reality is that we're still running below 5-year averages in storage of natural gas. The crisis of the attack on supply is not going away. As you can see, the political response has been to, offer more stimulus, which is only going to be more and more inflationary, broadly speaking. So the crisis isn't over. The attack on supply isn't over. They've definitely bought some time through the winter. The trade is over. And it's just a matter of time now before supply demand balances out and they start to put upward pressure on natural gas and oil prices again, because the lack of investment alone over the last 5 years, 3 years is enough to really, really set us back in terms of getting prices down to a more affordable level that the industrial market desperately needs. As you know, there's some real, regardless of Dutch TTF natural gas coming off, Europe is running about 70% of their zinc smelting capacity. They are running at about 40% of their total aluminum capacity, output capacity. There are petrochemical companies. My camera just overheated and went off. I'll turn it on in a minute. But there are petrochemical companies that are in danger of shutting down their entire operation. And with some of these huge chemical crackers, Imran, shutting those down doesn't mean letting them cool off for a couple of days. Shutting them down means they are mothballed, right? All the products coming out of them, gone forever, not coming back out of them. So, that's the part where the crisis, where the rubber really meets the road. And I got a feeling that, there's already been a letter from leaders of industry in Europe that have said, if we continue on with this energy policy, there is going to be an even more deeper industrial crisis here in Europe. So we're almost at the point where the political pendulum can come swinging back, but we're not there yet, as you can see, because the political response has not changed. Net zero is happening. In fact, we should be doing it faster. If you want to adjust, buy an electric vehicle, collect the tax credit, which is basically spending a fortune on all, new renewable energy. You get a tax credit back, and that's your only option. So unless the option turns to, okay, you know what we should do? Let some of our local producers produce. We are still going to be in for a serious, serious crisis in the future. It's just a matter of when.
Interesting. And in terms of positioning, we get the sense you're still in the name, you're still in the stocks, but you're not so much in the commodities right now. So you still have some strong faith that the likes of XLE and XOP are probably the safer place to park your capital right now in the energy sector than the commodity. Is that fair to say?
Well, yeah, the big observation that I'm running my book on right now, Imran, and running this trade on is I picked this point from July 22nd, which was after one of Biden's SPR release announcements, where from that point, let's do this first. The oil market is down 11%. The gasoline market is down 11%. That's what the Biden administration drew a target around, and they were trying to directly affect with this SPR release, right? From the same point in time, diesel fuel is up 12%. XLE is up 18%. Right? Now, this is just from July 22nd, which is 4 months ago or 3 months ago. And we've all of a sudden got this massive dislocation in all of the energy trades, right? The trade that the Biden administration is trying to get to work, gas and oil and paper markets, they're going lower. The stock market, the refineries, they don't want to hear about it. The refinery margins are still 5x, historical norms. Marathon Petroleum, Valero, Phillips 66, those stocks are on a run like they're tech stocks. Tech stocks in the 90s. So I'm just saying, the market is sort of the dividing line out right now between what it wants to value and what it doesn't. And if I keep saying that the people that get stopped out of their, the portfolio managers that get stopped out of their social media, et cetera, and technology on the downside, what do they do with the cash that's left? If I'm them, I got to look at the board and see what's working this year and figure out if it's going to work between now and the rest of the year and maybe invest in that. And that's why right now the disparity on the year between technology, there's some sectors of technology that are down 50% on the year, like internet and software, where now you've got XLE and XOP up 50% on the year. To me, between now and December 31st, that's just going to steamroll even wider. That's my opinion.
Yes, there's a rotation trade going on out of tech and into energy. I mean, it makes sense, right? I mean, that trade has just been happening for so many years the other way. And now you've had this disastrous year where stocks are down and bonds are down, and nothing in your portfolio has provided you any diversification except for energy, right? And so you kind of have to allocate a bit into energy, right? If you're not in it, because you're trying to look for things that are going to diversify you against the inflation trade where bonds and stocks continue collapsing. And where else can you go? Gold's not a no-brainer that's going to work, right? The only thing that's really proven itself to work has been energy. So I think you're right. I think that rotation continues, and certainly the price action in the names in the sectors is showing you that there's a strong underlying bid there. Right?
That's the tip of the spear of the inflation trade. That's where we headed.
Anything to add, Darius? You want to, or you on that topic?
The one thing I would add, just behaviorally, we know, when you talk to investment advisors or, sort of, anybody who's taken over someone else's account in the last few years, one of the if you will, one of the things that is always typically discussed is, when they transition accounts, it's like, okay, so-and-so has legacy holdings in XYZ tech stock or these tech stocks, and they can't sell. They can't sell. Because they want to sort of accrue the taxes and all that stuff. I wonder if that changes here in Q4 in terms of tax loss selling season. Now, I can hear both sides of that argument. I'm not entirely sure which wins out, but I do believe this is the first time in a really long period of time where the sort of discussion from investment advisor to end client, banker to high net worth individual is actually around actually selling some of these securities. So it's pretty interesting.
To crystallize the tax loss, basically.
Yeah, exactly.
Interesting. Yeah, you're right. Because normally they'll have gains, right? Not losses to take.
Yeah. You can't pry these things out of people's accounts. I know funds that manage sleeves of funds around people's legacy tech holdings. Like it's pretty remarkable.
Yeah, no, I mean, just behaviorally, like you say, my sense is that the squeeze is on right now, but if it lasts till Thanksgiving, I think it's doing well, because I think we're going to have a weak close to the year, not a strong close to the year. I mean, seasonally, normally we rally into year end, right? And whilst I think we may be rallying into midterms and even into Thanksgiving because of the setup, I've got a sense this year is going to end quite badly. That's just and that's my, let's call it my spidey sense, right? It's just from looking at the markets for 20 years, you kind of get a feel for ebbs and flows, and I wouldn't be surprised if this one ends badly. Right.
Is there anything that sort of like sticks out in your process that sort of makes that spidey sense tingle more than others?
It's just the sense where partly, that everyone's trying to play the squeeze, everyone's trying to play the rally. And I feel that when that happens, it does come, but it comes very early and it comes very quickly, and it doesn't last very long, basically, right? So I think that's the setup. I think, like you said, everyone looked at the summer squeeze into August and doesn't want to miss it again. And now you've got the big bears like the Michael Hartnett's and the Mike Wilsons of Stanley's and Bank of America. Even they're throwing in the towel short term on the bearish mood and saying, yeah, the squeeze is coming. And you've pretty much got a consensus bear market rally here. And when it's that consensus, I struggle to see how far it's going to go, and then B, how long it's going to last, right? So there may well be, as Goldman says or estimates, like 200 billion worth of buying to do from CTAs. I don't know, but they're probably going to do it pretty quick. And if they don't do it, the market's going to front run it anyway pretty quick, right? And then it will kind of be done. So, like I say, if we pop our heads above 4,000 between now and Thanksgiving, I'd take it as a Thanksgiving gift, and I'll be launching some Delta into it.
That is a Black Friday deal if you've ever seen one.
Black Friday.
Yeah.
I don't see the market
until like the end of next year again. Like that, think about that level in the context of where we're headed from a cycle perspective. Sorry to mean to cut you off, Tony. Just one quick point.
Go.
Like we're going to get the pause rally. I'm not sure. This one feels more flows related as opposed to the pause rally. We could get a pause rally from, let's say, I don't know, 3,400 on the S&P, 3,300 on the S&P. We might not even get back to 4,000 on that pause rally before markets look around at some point in the first half of next year and say, well, no, wait, we still have a recession ahead of us. right? To me, I think, you get 4,000, you have to be leaning on that on the short side, in my opinion.
I think Tony's going to disagree with us. Go on, Tony. What are you saying?
Well, no, not necessarily disagree. I just, Imran, I wanted to maybe slightly disagree with the idea that everyone is playing this short covering rally. Like, I don't feel, I always know one thing about when I'm trading, and that is I know when I am with the consensus. And we are just breaking this bubble in bearish sentiment that is, I think, a little bit bigger than you're giving credit for, right? I mean, like, Jared Dillian is one of the masters of this game, and he pointed out a tweet the other day that was like, nobody in the world is bearish enough. This is like end of the world kind of stuff. And you look at it and you're like, whoa, like this is from a serious human being too, And so I'm just saying, like, I feel like that bearishness has been as exquisite as I've ever seen it. And then when I think back to 08 and 2000 and tried to trade some of those technical rallies on the retracement, some of them went ripping through every level I had before they failed and then turned and made new lows, So I'm just saying bear market rallies have a habit of reeling in reeling in new bulls. And you've always got that retail factor that is, not really playing this rally from the long side or preying on markets with an E right now. They're preying with an A, saying, oh my God, is Facebook ever going to come back? Right? Is Google ever going to come back? And so
I agree that there are a fair amount of active asset managers who are probably too bearish and too defensive, but you've got to couple that with the fact that skew is as flat as it has been all year, right? Mm-hmm. So the guys who are underweight and bearish as hell are also hedging that upside tail because they paid up the calls. Like S&P calls have never been this expensive. They are insanely expensive, right? So normally the street is long stops and they buy puts to hedge themselves. The opposite is going on right now, based on where index skews trading. So whilst I agree sentiment is bearish and positioning is light, that's spot positioning, but option positioning arguably is hedging that, which then makes me think, so if everyone's bearish but hedge for that upside tail, does that upside tail need to be as aggressive? And that's where I'm not sure on that view. But that's why I don't think the rally is going to be quite as spectacular as we saw in August, because that wasn't the case. The skew wasn't going so crazy flat in August as it is now, which to me looks like a lot of institutions are buying the arse out of calls, basically, right? And on that note, we've got Brent. We've got Brent from Spotgamma.
Right on time. Are you kidding me?
Bang on time. The minute we start talking about options, he comes in. He's like, he knew it. Yeah.
I didn't have much value to add to anything that took place before. I'm just guessing.
Well, you are the star of the show now, my friend. How you doing?
I'm doing awesome. Thank you, guys. Imran, I don't want to segue. I did email you yesterday. I was going to be a little late, so I apologize for that.
You emailed me, did you? What did you say?
Yeah. So I'm not just that kind of guy that just doesn't show up.
Yeah, no worries. I must have missed it. No worries, man.
This is great TV.
You're getting an inside look now. But what are your thoughts? Because you obviously analyze the option flows and stuff. You're probably even closer than I do. So what's your sense, Brent?
Yeah, there's two things. One, I saw this chart. It's a macro chart, but it was the seasonality basically into elections. And I put it up on Twitter, but if you look at the way that the market rallies from right now into midterm elections, it's a vicious rally. And whether that's like the equivalent of someone draining the SPR to get oil prices down into the election, maybe there's some kind of similar phenomenon trying to gas the stock market into elections. I don't really know, but the point is that I think there's just this window right now where markets tend to rally favorably, and right after options monthly expiration on Friday, we've seen call positions come in. Imran, I heard that you were talking about skew and how there's quite a bid to call positions, and so we're now seeing like 3,800 for us is this equilibrium where it's like calls are building up over that level, and if we close up over this level, we're at 3,850 right now. Then that's a really strong tailwind to markets. And you just don't want to short that, I think, right now, because there is no reason really for the market to reverse at this point. We've had puts just get demolished into October expiration. There's kind of like an all clear for like the next week, I think, into FOMC. And then the other phenomenon that is really kind of difficult to analyze on any kind of day-to-day basis is how much volume is taking place, options volume is taking place in the shortest dated expiration. So last week we measured a couple of times where 40 or 50% of the options volume in the S&P 500 was for that day's expiration. So like you come in and 40% of the volume for the S&P was just for the expiration that takes place that day. So it's pure day trading volume.
What is that? What is that in dollar notional? Would you know what that number is in dollar notional?
I mean, it's obviously billions, right? That's a great question.
I mean, it's probably in tens of billions, no?
Yeah,
but didn't they buy?
Numbers are too big, and then having to pare that down. But I'll have to look at that.
Didn't they buy $20 billion worth of puts and $6 billion worth of calls last Thursday? Wasn't that the total notional amount?
When the market was on the low last Friday, when markets were on the, or last 2 Fridays ago, we were at 3,500. Someone came out and spent $30 million buying the S&P calls that expired that day, the 3,600 calls. And so those went from around $1 each, 50 cents each contract value up to $80 a contract at one point that day, right? In the market rally.
That was the trade of the year. That was the trade of the year, what they did basically. A one-day option.
Yeah. Oh, shit.
Crazy.
Yeah.
They spent 30 million premium on that. Are you serious?
That's what someone, when we talked with the options expiration show, someone had sort of mentioned that. So, and some people say, well, this is risk management, right? It's dealers hedging intraday using calls to hedge instead of futures. And I think there can be some of that. I don't think this is a lot of retail flow. I think this is institutional flow. And what I think is that people have learned how to use this leverage as a momentum trade, right? Like I can suddenly buy 20,000 at the money calls that expire in 2 hours and force the market higher. If I have I don't even need that sophisticated of a model really to kind of figure out where I can exact the most leverage. And I bring that up because you have these situations today or the last few days where, volatility kind of comes out of nowhere. And there's some great charts going around that say that market volatility now in up days is higher than market volatility in down days. And that is in correlation with the fact that this day trading volume, I just call it day trading again. Maybe it's sophisticated flow, which I think it is. It's not necessarily just retail punters. I think that just exacts. It's a lot of leverage, and it's a lot of stuff where we're all sitting here, and then out of nowhere, we could just get kind of like a sucker punch where the market's just up 2% on just the fact that someone came out and started buying the crap out of zero DTE calls.
The point you made.
They're over in Greenwich. Firm name change. I think we all know what we're talking. I think we're all know what we're talking about.
Is very valid. Yeah. I mean, because I know firsthand from friends of mine who are still on these institutional side, they use shorter dated options than they've ever used before to hedge their books. And the reason they do it is because daily options trade now, right? Like a few years back, you didn't have every single day with an S&P expiry. But now that you do, and the leverage that you get from those one-day options, and the fact that the market is so data-driven right now, because you've dropped all the forward guidance and it's like every data point matters. So a few years back, give a shit if the CPI comes in 50 bips worse or better, right? Market doesn't care. Now the market moves 3% on a non-farms or 4% on a CPI, right? And it's only 0.2 different from expectations for crying out loud, right? That's how much the market is sensitive. So if you're not using daily leverage, daily options to protect yourself, you're a moron because the basis point cost of that one-day option is so small for the protection it gives you over that number that has asymmetric risk for the market, absolute no-brainer. So that's why the volumes exploded into the billions, because the instos have cottoned on that this shit's the wrong price and I can protect myself quite cheaply, right?
It scares the shit out of me because think about what this means. If there's going to come a time where everyone's leaning on one side of the boat, from the next, let's call it next 2 or 3 days, data release, economic calendar perspective, and it goes the wrong way. Yeah. And then you create the gamma squeeze to the downside as a function of everyone, kind of unwinding those hedges. So to me, it creates instability in the marketplace.
It creates leptokurtosis moves, whatever you want to call it, fat tails. It creates the fat tails. Definitely.
Right, because your friends, Imran, hedging themselves, that just adds convexity to the market for somebody, right? Somebody's got that risk, even though the firm is hedging smartly, arguably, right? That means somebody else has got to hedge the other way.
Yeah, 100%. Yeah, that's right.
And we were looking at,
you call it weaponized gamma in that it's just it's so short dated, it's so big. The dealer provides the liquidity, but if the move happens, they're forced to go with it, basically, right? And the futures just accelerate. And what would be a 2% sell-off turns into a 4 to 5% sell-off, basically, right? So,
right. And we put on Twitter, like this is the recipe for a flash crash because, and I feel that way because you could easily drop a scenario here where like some real headline comes across when everyone's like expecting one thing, and then it completely shifts. Darius, just as you mentioned, people are like, "Oh, Brent, you're fear mongering stuff." I'm like, we could crash up as a result of one of these triggers, just like we could crash down. But these technical positioning elements are, look, the wheels could come off the bus really quickly, and that market would that move would mean revert very quickly. But as you mentioned, like a 5% move on nothing other than this positioning element, quite possible to see something like that happening. I mean, I was reading about the Citigroup. Remember, had a flash crash because someone on the Delta One desk put an extra zero on an order. It's like you put an extra zero on an options zero DTE order, and man, there you go. It's like you could get easily that kind of a move. So, and I would just say last kind of point on this is that S&P call volume is at a record. Just over the last couple of months, we've really exploded in terms of call volume. But open interest is not at a record high right now, right? So we have extreme call volume, right? Put volume's also going up, but extreme call volume and no real material increase in open interest. So again, this just backs this idea that it's very short dated positioning, zero DTE type flow.
Okay. Right. So people are buying literally same day calls, so it doesn't end up impacting the open interest, basically.
That's exactly right. Right. So if all these macro funds like we're worried about upside crash protection, we would buy probably like December's expiration or a quarterly or something a little bit farther out, even if it's out of the money. But in this case, what we're getting is people who just seem to be flooding into whatever the option is that they choose this morning. They close it by the close of trading today, and so it never reflects an open interest.
It's funny because when the retail crowd were doing it, it was YOLO and they were just speculating via these super short dated calls. But now the insto crowd are doing it. I think that's the hedge underweights. It's not. So they kind of expect. Do you agree with that? Do you think they're expecting they're probably going to lose the premium, but it's a few basis points, so I don't care, right? Yeah. Whereas, do you see what I mean? So because I'm underweight anyway. So if market melts down, I'm actually outperforming and I've wasted a few basis points. But the retail guys are actually spending the money that they had on those calls to try and get rich. So it's quite a different dynamic, right? They're buying it for different reasons. Yeah,
I think that's totally right. And it, if you're just replacing, what you'd be hedging with futures with short dated calls, then that makes a lot of sense. So what you said there, really sinks to me to make some sense. But the behavior in a way is ultimately the same. I mean, GameStop and all these other systems that became systemically important stocks back in January of 21, excuse me. Everyone was going nuts, right? And everyone was really freaked out about this. Well, now you got like kind of the same thing happening in the S&P options. And you're kind of like, well, like no one really cared about this until something broke, right? With GameStop. And now it's like, it feels to me like a very similar thing where, okay, maybe all that volume backs off and we calm down, but like the odds of that causing a market dislocation here, feels very high. And you can get, these moves that people think are real, which are just, like exhaust from hedging flows that are coming in the market that have just gotten, too short dated, right? That invoke too much leverage.
So you brought up a good analogy. Who's the Melvin Capital in this scenario? And is that systemic?
I mean, it's a great point. A lot of our customer base, there's a lot of retail guys who like to sell short dated options. Like they think the vol in general is higher for those and they like to sell those. And I think that is a very large component of who historically traded the shortest dated options. So I think those guys are at risk of getting run over because, if you're selling today's, calendar spread or whatever, or condor or whatever you may do, and you're wrong, like you got to suddenly run for cover, right? So you got to flip to buy. If you were short puts, and that just adds to the downside pressure. So I don't think that a real fund can put too much speculative size into this, right? I just think that there's not a whole lot of investors out there that want to hear that your fund is slinging around, 1 day's to expiration options or whatever. But if you're hedging with it, it can make some sense.
My take on that would be that it's the dealers that are providing the liquidity, right? So if the instos are buying it, you might get a bit of retail selling, but like if we're talking about yards, we're talking about billions of notionals, It's the liquidity providers who are providing it. So they're just running big short gamma risk, right? And you're seeing that in the erratic price behavior, right? You're seeing that in the intraday vol, that because dealers are short gamma, right? And they're having to chase it whichever way it goes. So I think it's just that dynamic. So the risk gets translated through to the price swings quite quickly. Whereas when you had a Melvin Capital, they were just sitting there short a load of stock. They're not buying it back every single day. They're just running a big short position. And after a breaking point when they lost too much money, they're forced to cover. That's not how dealers operate, right? When dealers sell optionality, they are hedging it on a daily basis. So they're going to get chopped about a bit on intraday moves. But in general, if it keeps trending higher, they're covering it all the way up. And all that you end up really seeing is market's going to sort of accelerate. A 1% day turns into a 1.5 to 2% day. And also implied vol goes up on the upside because that's where these guys are getting taken short. So they have to reprice that optionality. They maybe changes a few hands. Some dealers throw in the towel and buy it off some other dealers, and just that bid for calls that we are seeing translate through to the market is what you're seeing basically, right? So I don't think there is like some big structural short that's going to get blown up on it. I just think you're just going to see it manifest that way into the market, the way we're seeing it seep into the market now. You know?
Really?
You wonder maybe like a Delta One situation, or I don't know, maybe something like that, like a kind of like interdealer type activity. I'm not sure.
But let's go back towards something that obviously me and Brent have been chatting a lot about, the vol side. But what do you guys fancy? What do you guys think about the dollar wrecking ball? Tony mentioned it earlier, but now we're getting a bit of a pullback in the dollar, obviously. But when we were at the highs of the dollar, we were seeing quite a lot of panic from, you had the SMB with swap lines, you had the Bank of England with intervention, you had the Bank of Japan with intervention. I mean, all hell was breaking loose, really. So do we think the dollar's done? Do we think we've seen the high in the dollar? I know we think yields are probably still going to have another go against. Does that mean the dollar's not done yet and it's going to actually make new highs? And what's the sort of timing around that? Darius, let you start with that one.
Yes, I mean, one thing you have to start off is a couple things I'd say. When you're thinking about currencies, they operate a little bit different than sort of other types of markets, securities markets, particularly bond stocks. Currency markets tend to trend; they tend to have momentum, and you typically need like big catalysts to reverse momentum. And so, generally speaking, if you're looking at a currency chart and it's got positive mo, you're better off, sort of fade or not trying to fade that positive mo. We built a few models here, 42Macro, that try to explain what's driving the currency market, and kind of in reverse order. The terms of trade shock that we're seeing abroad in Europe is pretty much, got probably not probably, it's roughly around a 0.4 R squared in terms of, kind of explaining what's happening in the currency market. And then when you look at, sort of the fiscal shocks that we're seeing, particularly in places like UK, et cetera, that's got about a 0.5 R squared in terms of explaining the currency market. The model that has the best sort of predictive power in terms of explaining what's happened over the last year in the currency market is the, kind of the most obvious model, which is, kind of real interest rate differentials and changes therein. And so as long as we continue to see the Fed out front in terms of policy repricing, it's very likely that the dollar continues higher. Now we're at a particularly interesting interval. And I say this because historically we've seen the European currency, the euro, trade positively alongside its growth dynamics. It's much more it's much more correlated to rising growth expectations than it would be to rising real interest rate differentials, or the compression usually in the interest rate differentials between the U.S. And Europe. And so one thing that is sort of, I would say, new, and I think the markets are still trying to digest this, is the fact that we're seeing a pretty substantial fiscal response to the energy crisis in Europe. I want to say Germany's outlined about 200 billion euro. That's about 5% of German GDP. You got France at another 100 billion euro. I think that's 2.5-3% of French GDP. And the market is not repudiating it the same way that the market repudiated the British pound. And part of the reason the market's not repudiating that is because, again, the euro is a structurally current account surplus nation. It's not a twin deficit nation like the UK, which needs to have this currency sort of reprice and revalue to sort of attract global capital to finance that twin deficit. So I think this is potentially positive for the euro. I still think we have a few more innings left to go in this dollar bull market scenario. But one thing I think the markets are smart about right now, based on everything that I've I've outlined just based on the general history of currencies and how they operate, you're seeing open interest in the euro, looking at the euro USD net non-commercial net length. Open interest is, or total open interest rather, total open interest is in the 1 percentile of the trailing 1 year. If you
So
look at the British pound,
everyone's short euro, right?
no. So they're actually net long euro. If you look at speculative net length as a percent of open interest, we're at plus 7%. So effectively, euro shorts have covered pretty ferociously. But open interest is all the way down in the first percentile of total open interest over the last year. That compares to 85th percentile for the British pound. We're in the 92nd percentile for the Japanese yen. So effectively, the markets have really gone and closed out their euro shorts. So much so that they're now net long euro. And I think this is something to monitor, because again, if we do start to see the fiscal response in the Eurozone really pick up and influence, kind of Eurozone growth expectations higher, you're going to start to see the ECB respond in kind and ultimately flow through the currency market. So we may be getting close to the dollar peak here, although I do suspect that, until we get the Fed pause, the dollar's got momentum to the upside.
Tony, what are your thoughts on the dollar?
I'm firmly in the spectator seat, Imran. I have, on the bull side, you've got, technicals, price action, where, the dollar index, for example, finally dipped to the 50-day moving average today, and that's nice, but it's still well within trend. Not something I like to fight at all. And then on the other side of the coin, you've got two central banks with their lines in the sand now because of the dollar wrecking ball in one indirect way or the other. There's likely not only one cockroach or two, and I'm kind of on the lookout for other central banks kind of stepping in if necessary. And then, you've got that sort of lightly coordinated intervention between the Bank of Japan and that journal article in the morning that said that the Fed would consider the pace of rate hikes after the next one or something like that. So, that stuff to me lines up. And also the Barron's cover with George Washington in the front double bicep pose is always a big sentiment bomb. There may be a Barron's cover curse component to this trade, because it literally hasn't traded higher since they posted that article. And we'll see if it starts eroding things on the downside. That'll be good for my commodity trade. If it gets back on its bullish horse, that might be a headwind to my commodity trade. That's how I'm looking at it. I've got accountable arguments on both sides of the ball.
Yeah, for what it's worth, I was thinking that last week on one of my daily notes, I was saying to my subscribers that it seemed that the TTF gas prices, the way they were going, we had PMIs in Europe this week. The market actually traded really well, even though the PMIs came in worse. So that, again, is a bit of a bullish sign. So I was thinking maybe a 102, 103 target on the euro in the short term, given the ECB meetings this week. And they've got a lot to do with regards to getting in front of inflation, right? With some of the PPI numbers coming out of Germany were ridiculous. So I feel there's a little window of opportunity for the ECB to have a go at being hawkish, at least trying to jawbone, especially hawkish, because it's not like the Bund BTP spread's been blowing out either, right? That's been quite well behaved. So it just seems that with TTF prices coming back down, with the terminal rates of 5% in the US seeming like a short-term peak, there is this little window for ECB to look like the hawkish one, and that might provide a few more big figures in the euro before. Ultimately, I think it's probably a sell on strength, but yeah, I'm tactically sort of leaning a little bit long on euro right now. All right, great. I think we've been going for about over an hour, so we're doing good. We'll try and wrap it up. We've mentioned, or we've been kind of all over the shop, kind of talking about the different topics that I wanted to cover. The only last thing, I guess, is if we think about sort of moving into year end beyond, obviously we've talked about the melt up risk. We talked about the pain trade probably being on the upside in the short term. I think everyone kind of seems to agree with that. But when do we think it's going to be safe to buy tech? Like the likes of ARC, the likes of maybe the semiconductors, things that have been absolutely beaten up, right? Is there any hope, or are we going to have to wait until middle of next year when we've seen the whites in the eyes and we've seen the Fed capitulate? What do you think?
Well, we see retail puke
Anyone
big
who wants
tech.
to go?
I'll go first. I think I still watch that move index. We talked about it a lot last time. When I see that move index hit like 100, right now it's about 150. As soon as we get down 125 to 100, then I'm happy to kind of just push some money back in and hold my nose and look at it. So my fear is that the market rallies 10 or 15% before that happens, and then I'm kind of like maybe buying a top. But that's kind of what I'm watching right now. I just think that until that interest rate pressure comes off and bond vol comes down, that equities are just not going to hold a material rally here. So that's what I'm watching for.
Yeah. See, Brent, what do you think, Darius?
So I'll answer this question two ways, right? So from a tactical standpoint, it's pretty clear that this is a market that is primed to go higher, materially higher, when the Fed signals pause. Right? I happen to believe this is not that particular interval. I think we're dealing with just more flows dynamics in and around the Fed and around the midterms, and still in the middle of the earnings season. When that happens, and again, we suspect that pause will likely come in some point early next year, you're going to see a ferocious rally in tech. You're going to see a ferocious rally in the long bond. I tweeted out a couple of months ago, bond investors should not buy a bond until they're ready to buy stocks, and stock investors should not buy stocks until they're ready to buy bonds, because both of those things are going to happen in terms of rallying at the same time when the Fed hits the pause button. From a structural standpoint, there's a couple of things that I think are kind of out there as boogeymen for later in 2023. When you look at sort of sector, different intermarket relationships, one thing we track is the high beta, low beta ratio as a proxy for overall market risk. It's pretty clear that we've gotten nowhere near pricing in a recession. If you look at financial conditions indices, investment grade credit spreads, et cetera, we've priced in a non-recessionary cyclical slowdown, but we have not priced in a recession. And history shows, looking at our research, in order to achieve the kinds of downside deviations on inflation that the Fed is targeting, you need a recession. These things don't come out of nowhere. And so it's our belief that the Fed is going to hack and go at this until we get into a #actual recession. And because that has not been priced in, there is potentially a lower low of market risk associated with that process, that recessionary process, at some point in mid to late 2023. I'm sure you'll rally for several months, once the Fed pauses and the economy is not in recession still at that point in time, which we happen to believe it won't be. But the process, it's going to get to a lower high, and eventually you're going to have to sort of hit the sell button on that. And my issue with, going back to your original question, and I'll shut up, the dollar is at a very asymmetric level from the perspective of its long-term time series. And history shows that, there's a few things that tend to be inversely correlated to the dollar, which is the supply of dollar credit, global growth, and the relationship between cyclicals and defensives from a sector and style factor perspective in the equity market. And so tech has gotten this real premium multiple, really throughout my career, kind of starting in 2011, 2012, really the last decade, because of the persistent dollar strength that we've seen. And it's our belief that, based on a variety of policy-driven factors, not the least of which will be the Fed likely throwing in the towel on a 2% inflation target at the end of this process, we do believe we're going to see a structurally lower dollar, structurally higher bond yields, and structurally lower valuations and investor demand for digital economy securities. And so I think, kind of Tony's got the right idea in terms of the trade. I guess, my job is sort of try to help investors think about this from a multi-duration perspective. But I definitely believe where Tony's kind of generally been positioned all year, it's kind of the right. That's where we're going to head for the next kind of 2 to 3 years from a structural standpoint. So to answer your question, I don't know that the buy the dip in the tech is the right place to buy the dip.
No. So basically, it sounds like, there's a lot of work to do before you feel comfortable calling a bottom in that sector. I mean, there's also the whole passive investment vehicles argument, right? Such a large percentage of the passive money that's flowing into the market is going straight into tech because they're the mega caps, they're the large caps, right? So the question is, does that passive flow of money come down as we go into a recession and less money, and there's more unemployment and there's less money flowing into those 401ks, basically, right? So do we see a load of redemptions later down the line as unemployment rises? That then is a liquidation event that is a large amount of capital that's parked in tech, basically, right? So I think that's really where you want to see the bottom. right?
Yeah, well, just to quickly address that point, part of what's driven passive has been this sort of disinflationary era that's allowed the Fed to suppress volatility. It's allowed the sort of, the kind of the issues that we've seen in Europe that have contributed to, kind of negative interest rates there have really, contributed to, dollar strength and ultimately tech strength and, associated, kind of when you put those two things together, you have passive flows from a fully employed Americans is contributing to their 401k. At the same time, you have a raging dollar bull market that is, sort of investors are chasing that, Swiss National Bank buying Apple, et cetera, et cetera. It was a perfect storm to get the kind of share of technology market cap in the index weight to where it was, kind of at the highs of this year. And we might not see those highs again for another 20 years. Because again, we're going to have a structural volatile market. A lot of investors foreign, one stat I haven't even thrown out, but we've seen well over $10 trillion of international capital flow into the US economy over the last couple of years. If you look at it over the last, kind of 3 or 4 years, I mean, these numbers are staggering. We basically doubled our net international investment position in like the last 4 or 5 years because the US has been the cleanest dirty shirt abroad. Well, when the dollar is in a kind of a raging bear market as a function of all these policy drivers and policy changes and some of these structural changes we may see in our labor market, then it's the likelihood that we continue to see A, passive flows into tech, and B, passive flows in general it's much likely to be lower. So it's our belief that it's active from here on out, and active will be increasingly forced to go chase where the opportunities are, which is in kind of sort of the cyclical sectors and style factors in the universe that have been left for dead.
Mm-hmm. All right. Well, in closing, why don't we just go around the room just saying then, okay, in a nutshell, Q4, bullish or bearish? So Tony, we'll start with you. Is it Q4 roundtable? For this quarter, are you thinking we're going to finish the quarter higher than here or lower than here?
So end of the year print. I would say the end of the year. Yeah, the end of the year print, I would say, is lower from here. I still think that we're going to see like a really, really widening of the yearly performance where tech finishes worse and natural resources finish better from here still. And I think we see a lot of money flow into that. I think that post midterms, I think that we see a huge WTI rally. And then you see stocks really get out away from moving averages on the energy and natural resources side. I think that there's somewhere in between now and then we get to that pivotal point in the S&P where stocks, turn and could end the year, right on their ass with, I love the idea that Darius brought up with like, where's the tax loss selling going to be now that you've got real losses on the books, right? Tax loss selling was a cute conversation when, your stock was down 3 or 5%. This year it's down 50, so it's going to be a really big decision to see how that plays out. But that's really it. That I don't want to get too far out ahead of myself, but I think generally speaking, because the S&P is weighted most heavily with technology, that the last print of the year is lower, but natural resources live through that and trade higher.
Sounds good. All right. And Brent, what do you think?
I think we rally into the election and then sell off after. So the low, I'm looking for a low, Christmas low this year. That's what I'm thinking.
Okay. Darius?
That was that's one of the calls I made earlier in my career, not early. That kind of created a talking head personality out of me was that Q4 call in 2018.
Right.
They have a lot of similar market dynamics, a lot of sort of, I wouldn't necessarily say tax loss selling. I think it was more sort of investors taking down gross into what was a shock. Clearly, investors have already taken down gross, and we're seeing that obviously in the call skew data, et cetera. Investors are really hedging for upside protection, again, because risk works in both directions. So that protection is giving them protection against upside. So the one thing I would call out, and I'm pulling this up now, kind of filibustering as I pull this up, I'm a Bloomberg, but we haven't necessarily seen hedge funds do poorly this year. If you look at the global hedge fund index, it's only down 4.6% year to date. The equity hedge fund index is HFRX indices. It's only down 4.3%, right? That compares to the S&P that's down 23, 24%, even as of we're only down 19% as of now. So yeah. So it's this asset class is working. It's doing for investors what it's supposed to do. Now it's not generating positive absolute returns, but it's not generating negative enough absolute or relative returns to suggest that we're going to see a mass exodus out of this asset class. And if we see a mass exodus out of this asset class, then you're probably going to see a lot more selling. If we saw a mass exodus out of this asset class, then I think we would see into the end of the year kind of institutional career risk management, which is fucking, I'm already down a lot. I got to YOLO it and just try to hope for a good year. I don't think the behavioral dynamic exists for that, because on a relative basis to the market, hedge funds are actually having a great year. And so I don't think the YOLO desire is there. And so ultimately, I think we sort of, are likely to track where our net liquidity forecast suggests we're likely to wind up, which is, 3,200 is our target. It doesn't have to get there on December 31st, but I do believe we'll hit 3,200 at some point in the next 3 months.
Oh my God, we are so bearish. The Avengers are so the bearish Avengers.
Well, the market's down 20%, bonds are down 30%, Bitcoin's down 70%. It's been right to be bearish. Let's not.
No, it has.
Let's not make fun of it.
Funny. We're always quite grisly on this round table. But I mean, I said it as well, right? I think we potentially get a squeeze into Thanksgiving, and it's similar to that's like the week after midterms, basically, isn't it? Or a couple of weeks after midterms, and then I think this market's probably toast. Yeah. So let's see if that's how it plays out. But it seems to be 4-4. A bit.
Do we just jinx ourselves? So basically, the market's going to puke into the midterms and then rally ferociously into year end.
Yeah.
So we were all bearish. We were all bearish with the last one, right? And then we got new lows.
Yeah.
We were all bearish. The market rallied hard, and then I think we were right by like 5 handles or something like that.
Well, yeah, it was 20%. It was 20% low to high in the accused, though. That last show covering rally, that was well worth a play.
That's
definitely worth playing, 100%. And you got it. You nailed it, mate. You nailed it.
You did, 100%.
You nailed it for sure.
All
right, cool.
Then you're as good as your next trade.
Thank you guys. Yeah, I want to thank you guys for coming. As always, it's been a good one. It's great to get you on at the end there, Brent. I'm glad, and you rocked up at the perfect time as well. But until Q1, I guess, and I'm sure I'll speak to you all before then. But good luck, and thanks for being here. Take care, guys.
Appreciate you.
Great job, Imran.